Hey, everybody. My name's Andy. My channel is Finding Value. Today, we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. So, we're going to dive right in, take a look, see what people are sharing. If you want to follow me, @Finance, and if you want to join our community, finding-value.com. That's where I dive deeper into all these topics, looking for potential investment opportunities. So HFI Research says the production matrix is everything you need to know about U.S. oil production. The blue line, the EIA 914, lagged real U.S. oil production growth from the beginning of 2022 to the middle of 2023. But the reality is that production, which is the orange and green lines, shows flat production since 2022. Flat production since 2022, and we have not increased. Is that due to the oil price, or is that due to geology in U.S. oil production? And remember, 95% of oil production in the world, 95% of the growth came from U.S. oil production. And I am watching this like a hawk. If this starts to decline, or if the best we can do is hold steady even, I think oil prices are going to go up. And if we cannot go up in U.S. oil production, basically that means that we can't grow world oil production, at least out of the United States, which is 95% of the growth. It means that this investment, the entire investment world will change if we get into problems with oil. Oil will be a great investment, so will precious metals, if that were to occur. Consumer revolving credit just nosedived, something you don't see outside of great financial crisis or a COVID event. Look at this thing dive. What the heck is going on here? Big dive there. We had a dive here for COVID, and then we obviously had a pretty big dive from the great financial crisis and 2000, 2001. It's like we're going through a recession right now, and it's trying to be hidden. JSG says total commercial petroleum stocks, excluding other oils, built by 9.5 million barrels week over week. The valuation gap has narrowed where WTI is $8 undervalued with a fair value price of $81 a barrel. Price is now within one standard deviation with Z-score of minus 0.7. Big builds to start year, but first few weeks of the year, always data wonky for your information. So that's where we're at with commercial inventory. We're slightly undervalued given where we normally trade, which is 81 bucks. Eric Nuttall says global oil inventories are a mere 5 barrels away from their lowest levels in recorded history. Demand is outpacing bearish expectations. U.S. shale continues to disappoint. OPEC spare capacity is tightly held by those with will and intent. This is why we are bullish on oil stocks, according to Eric Nuttall. Look how low we are. This is off the page compared to the other years. Look at how high this year was. This year was 2021. So 2020 was the purple, 2021, and then we just squeezed down, 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 all the way to 2025. NYMEX should be worried. Cushing inventories fell to their lowest level since 2014. The difference this time is Cushing is irrelevant to physical oil. It means that WTI as a pricing tool is becoming less relevant to actual physical oil. NYMEX needs to update the contract. Yeah, it's curious. I was reading this and I'm just like, man, it seems like all these paper contracts are just filled with crap. The paper contracts pricing gold, silver, and all that other junk over there, and it seems like it's impacting oil as well. Yeah, buddy, lightweight. Who's that from? Yeah, Ronnie Coleman. Ronnie Coleman, the weightlifter. Yeah, buddy, lightweight. So global total oil stocks. Look at this thing. What a mess. Reported is way lower than what JPM Global and these other guys think that could be coming. I think what they're doing here is that a lot of guys are projecting Saudi Arabia to come back online. and refill inventory. But I think Saudi's like, I don't want to do that at the current price. Why am I going to refill your inventory levels at a cheap price? I'm going to not do that. So we've got kind of a war going on here of OPEC not wanting to fill up commercial inventory levels because of the low prices. Jacob King, he says, whenever I state facts useless, the most common response from the maxis is, well, gold is useless too. The irony is they say this is containing gold chips connected to a Wi-Fi router that also uses gold. Even their BTC was mined with machines containing gold. Gold is used everywhere. It's clear there's little critical thinking among the laser-eyed cult. It's almost as if a lobotomy is a prerequisite to being a maxi. I'm seeing a lot of people talk about crypto on my feed on Twitter. I don't actively search it. I just see them pop up all the time. And everyone talks about price. That's all they talk about with Bitcoin. They don't talk about adoption. They don't talk about any of this stuff. They talk about making it a reserve for governments and how the price is going to go up to like 1 point something million or $1 million or something like that. I think it's pretty useless, but that's me. EIA weekly oil inventory report. We've got crude down about 1 million barrels. Cushing's down 2.5. Gasoline and distillate is a build on the final product side. Company says bonds are about to seriously break some crap, and you are all totally unprepared. And that's the yields continuing to go up and up and up. This is the UK 30-year yield, and we're also seeing the United States yields rip into the upside. Paul Saladino, however you pronounce it, says the big price spike in nat gas, the actual big one, will only begin once the market broadly recognizes we need higher production immediately. Most will laugh in your face if you say that right now. So it's going to still be a minute or two, but balance isn't getting any looser. So looser means that they're adding natural gas to inventory. Tighter means that you are squeezing it out of inventory. The problem is that our inventory days of coverage have shrunk quite a bit in relationship to demand. And it's hard to swing all these producers back and forth to quickly increase production. And then if inventory starts to grow, they have to quickly reduce the production of it to balance out the inventory. This is like threading the needle here. It's really difficult and it's going to mess things up. What I think is going to happen is that we are going to see bigger spikes and more volatility in natural gas. And then eventually, as liquefied natural gas terminals come online and we burn more and more natural gas for electricity, we're going to go up and up and up. And we're going to see a lot of volatility though in the short term. Get ready for this. Rock bottom entry says inflation isn't over. Lumber is showing a textbook bottom setup here with a shoulder head shoulder, a breakout, a retest. So that's that breakout back test. And we look good to go higher in lumber. Lumber is used in building homes. And historically, people would compare lumber to gold or lumber to other things, which is a measuring stick of the market conditions. So if lumber continues to go up, what that means is that home builders are saying, feed me more lumber. And that housing, home builders are pulling that lumber into new homes. And new homes, historically, if you sell them with a loan against it, historically that is very inflationary. Coming down, I think about this chart often. What happened in 1980? And I forgot to post another chart here. I'm gonna bring it up here real quick. Oil production per capita. I don't need it by country though. So this here, it says what happened in 1980. It says the Great Prosperity from 1947 to 1979, pay rose with productivity. Wages and overall compensation for production and non-supervisory workers, now about 82% of the private sector workforce, tracked steadily upward alongside gains in productivity. The rising value of goods and services per worker meant rising pay, but that ended in the 1970s. We can see that productivity kept going up, which is this dark line, and then the average hourly compensation rolled over in the 1970s. What I think might be driving this, a lot of people say, oh, we went off the gold standard. I think this is what's driving it. So here it is. Global per capita oil production. So if we were to look at global per capita oil production, which is right here, we were going up, 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 and it rolled over in the 1970s. And then we went down and have gone sideways. So this is your global per capita oil production. Oil production per capita, and the more that it goes up, is a function of wealth. It's energy per capita, if you look at it that way. So I think what is occurring is that since this went sideways like this, it almost matches the way that this goes sideways here for compensation. And I don't know if there's a correlation there. Let me know what you guys think, if there's a correlation between oil production per capita and pay basically here. I also think obviously there was outsourcing that occurred too, that I think probably hurt this metric over time. But I think the big driver is global per capita oil production. It basically isn't increasing. I don't know if we can. I mean, not everyone's going to be flying a jet, is what I'm going to say. We just don't have the oil to do that. Jacob King again, it says Michael Saylor doesn't care about Bitcoin. In 2013, he predicted its failure. A decade later, he realized how naive investors were and devised a scheme to exploit them. He publicly praises Bitcoin and gambles with his company's cash because he knows it's in a massive bubble fueled by irrationality. His goal is to use its hype to lure retail investors into this struggling stock. As the hype builds, he dumbs significant positions in his now inflated stock, making himself rich. The SEC filings are public for anyone to see. He pulled the exact same stunt during the dot-com bubble in the 2000s. The difference is he failed to cash out in time and lost nearly everything when it burst. Mark my words, history will repeat itself. He's bubble decline here, and again, which is a very similar setup. Are we going to get a big decline here, and is he going to get busted? I don't know. Interesting to see all that, though. Silver inventories at record lows in London. LBMA silver inventories fall towards record lows. Look at this. LBMA December. Look how low that is, guys. It's just draining the vaults for silver. It says LBMA silver inventories fall towards record lows. Inventories declined 23 million ounces in December. Got physical. Physical, physical, physical. I'm not an ETF guy. So a lot of people ask me, well, is it okay if I buy SLV? And I'm like, guys, JP Morgan runs that. Like, you really want to be associated with JP Morgan? I don't want to be. I'd rather just go buy the physical. That's what I would do. HFI Research says, just so people are aware, we are 500 to 550,000 barrels per day lower than consensus estimate for the exit of 2024. He says, I'm skeptical of the data as I want to see more months of confirmation. But at this moment in time, implied U.S. oil production has fallen to 13 million barrels per day. With January being colder than normal, production won't be rebounding. I don't know. This looks pretty interesting setup here in oil. Howard Marks says, in order to be successful, an investor has to understand not just finance, accounting, and economics, but also psychology. Psychology is a big one. Ravi says, meanwhile, gold keeps rising, even with the collapse in the treasury market. We've entered a new era where gold stands out as the ultimate defensive asset and inflation hedge, in my view. Central banks are leading this transition, but I believe other institutions have yet to follow suit. And this is the correlation of gold and the US 30-year real interest rate. It was coming down. And we've diverted from that and have gone up recently. And there's that big divergence. And that's why he's making that conclusion. I think that people, countries, whoever it is unwilling to buy bonds. And I think that money is going into gold. That's what I think is really occurring. The commodity index divided by the S&P 500 ratio, few truly grasp the upside potential in commodities from here. Dump stocks, load up on hard assets. Yeah, kind of already did that, man. Double bottom here. We could see a potential spinning top reversal, which is that big wick at the bottom. You get these wicks at the top and the bottom there, tops for here and bottoms for there. And if you draw a line across through here, this is a double bottom. Yep. And we've got a bullish divergence occurring down here with the RSI. RenMax says mortgage demand is crumbling. For the week ending January 3rd, mortgage loan applications for purchases sank 6.6%, the fourth decline in the last 5 weeks. The level of conventional purchase apps lowest since 2011. 30-year FRM mortgage rates are back to 7%. There's mortgage rates up here. So yeah, affordability is having an impact on the housing market for sure. That doesn't mean that the housing market can crash. Well, some people will say, well, isn't the affordability essentially demand? Not necessarily. That is not the correct correlation per se. Affordability can impact demand if the affordability becomes out of reach for too many people. But you have a base of buyers that are underneath a certain affordability. So we could slow down in price growth, but if the price crashes and or if interest rates pull back, you've got a base of demand at a certain affordability point. That is not the same as 2007 when you had zero buyers. Affordability wasn't a problem at all. Everyone was already purchased and bought in and had garbage loans that were all going belly up. That is a completely different situation than what we are in today. Today, we have people that want to buy, they just can't afford it. So if one of the two factors, either mortgage rates go down or house prices go down, I think that mortgage rates are a bigger factor of affordability. You could easily see that through interest rates. I think if interest rates go down, it will save that sales will come back up and loan applications will come back up. It doesn't mean that if it dips a small amount for like a week or two that we're going to see this really move. We need to see mortgage rates drop a good couple percent, I think. Then I think that will move the needle. But there's a base of demand that just can't go in and buy homes at this exact moment. But it's out there. It exists. It's just at a price level that's a little bit below from where we're at today. If the rate of inflation means anything to you, that was just a new 30-month high for tips relative to nominal yielding treasuries. Look at this breakout here. It's like a big double bottom. We've got a breakout, a new 30-month high in this ratio of inflation protected treasury securities divided by nominal yielding treasuries. This is, I think, telling us that inflation is coming here. Inflation's a problem. We're seeing it in the 30-year and the 10-year yields going up, and we're seeing it in some of these ratios. Oliver Grob says cost inflation, all-in sustaining cost at the world's largest gold producer, Newmont, has risen 50% since 2020 to over $1,600 per ounce, hitting a new all-time high last quarter. This is your all-in sustaining cost from fourth quarter of 2020. Up, 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 up. This is inflation. And yeah, the price of gold is going up, but this is your cost curve going up of the largest producer here. And I'm sure there's multiple things, inflation in the system, and also probably perhaps lower ore grades could be impacting to some degree as well. Bitcoin. This signal is now projecting an 80% crash, which will make Bitcoin to arrive at 20,000 per coin, currently at 100. Why? Technical massive bearish divergence signal is this bearish divergence down here. This divergence is formed because it did not go through proper correction last time because of the YOLO longs who bought the highs 80K and up. It's getting too crowded and the market must punish the late coming YOLO bulls who looking to get rich quick. The conclusion here is the euphoria was created from the unsuspecting YOLO longs buying the highs. You can only inflate the price too long before the snapback. But when things are about to get out of hand, the fall is that much more devastating, which is the current sentiment in his opinion. Now, I wanted to share this, not for the fact that this looks like a crappy setup, perhaps, but for the fact that if we go down to $20,000 a coin, how does that impact mining? What does that do to the fees of Bitcoin? If we get to that level, can Bitcoin actually go belly up? Because the processing fees will be ludicrous to exchange a coin that is only worth $20,000. So what if the processing fees of these miners per coin go up to 100, 120,000 a coin? But the coins are only worth 20,000. They're not being subsidized by the coins themselves. So what they're going to do is they're going to put big fat processing fees. Is this going to be the end of Bitcoin here if that were to occur? I don't know, but I'm very curious to see what happens here. If that outcome does transpire where we get a 70 or 80% decline, and how that impacts the actual function of Bitcoin with the halvings that continue to occur and the increased mining cost, which will eventually be all processing fees. Grady says, looks to be time for commodities once again start a larger move when they outperform the stock market. This also fits with my posted article on the TSX Venture. So this commodities bull market is end of rainbow stuff, literally. CRB to SPX, and we're coming on up, breaking through if you were to do a line through there. We also have positive stochastics moving higher there. So it looks pretty solid there for commodities to outperform the S&P 500. The 2.5-year bullish expanding falling wedge. Here is Grady again. He says, not often a chart blows my mind after 3 decades in the markets, but this one did. I mean, if silver is a clear 13x from here, which I really do think it can go, imagine where platinum would go if this ratio goes back to all-time highs. So if silver goes up 13x, platinum would go up 6 times that. It says, think we are going deep into the wild. I don't know if that will be the case. We've got 2 massive, big, bullish hammer candlesticks, one in 2020 that I bought the crap out of, and one in 1982 for this ratio of platinum versus silver. We squeezed on up, and we're at the bottom end of this kind of a false breakout in the making is what he's got. And if this reverses hard to the upside, platinum could be one of the best performing metals in existence, probably in all-time history. Now, there's other things that you can look at. During the hyperinflation in Germany, for whatever reason, platinum was priced at 5.5 times the price of gold. 5.5 times. So silver didn't outperform gold. Platinum outperformed silver and gold during that hyperinflation. Are we coming into a similar situation here where platinum is just at super cheap levels that we could outperform? I don't know. It sure looks like that's a possibility. And Grady has obviously taken notice of that. Winners keep winning. Check this out. Just released the full report on Congress trading in 2024. Look at these guys, 149%, 142, 123. There's a handful of guys over 100% in Congress here. Look at these other ones. These guys are almost all beating the top investors in the world. And they're doing it probably by trading with insider information. That's my guess. Nancy Pelosi, 71%. Yeah, we got a real ethical group going on here, guys. Real ethical. And that's what I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. That's all I've got for today. So we'll catch you next time. Oh, just as a reminder, we have a 5 p.m. Sunday question and answer session coming up. Just an FYI. All right, guys, we'll catch you later. This is Finding Value.